This is all about logical thinking, right? We talked about base rates and rational thinking and Bayesian thinking and combining base rates with situations, evidence which is unique to the situation that you're studying. That all is fine. That's all about how to be a rational thinker. But there is a class of people who are basically quite irrational, and they're essential for civilization because they drive civilization forward. I'm talking about entrepreneurs, I'm talking about startups, I'm talking about people who don't think in terms of probabilities, who are not very rational about it, who are overconfident, who are over optimistic, but who are also resilient, and who think of failures not as the opposite of success but as an ingredient of success. I don't know who said that, but it's a quote that has stuck with me. And they keep trying, and one day they get lucky, or at least some of them get lucky. But those that do, they propel society forward, they solve big problems, they make a lot of money, they become role models, and we need such people, right? So even Danny Kahneman wrote about it in his book Thinking Fast and Slow. So when you talk about don't ignore base rates, if you think about it, some of the most successful people in the world ignored base rates. They did startups. They did things that were very, very difficult to accomplish, and ultimately they became successful. So the idea of don't ignore base rates has a relevance in the context of rational Bayesian thinking, maybe public market investing, but it is not so relevant in many matters of different contexts, such as startup ventures or investing or being an entrepreneur. I mean, Elon Musk, I remember once said that when something is important enough, you do it even if the odds are not in your favor. So, this is the same point, and it's just important for society or something else. And this is exactly how patriots think, right? I mean, think of Captain Vikram Batra in Kargil War and what he did for the country. He laid out his own life, but if he was thinking about base rates or laws of probability of success, he probably wouldn't have done what he did, right? But he's remembered for what he did, and he sort of ignored base rates over there.
That was really interesting, sir. And I remember when you were speaking about the irrational part, the name which was coming to my mind was Elon Musk only. So there was this famous meeting between Elon Musk and Charlie Munger, where Charlie Munger laid out several reasons how he will fail, and he still went up there and proved him wrong. So of course you can't have that with a base rate, but there are people like Elon Musk, and there are many people, not many, but there are some people like Elon Musk who, for whom you can't just look at base rate and ignore, right?
See,
And but your
the
main
graveyard
point,
of the graveyard of entrepreneurs is full of those who see, all entrepreneurs ignore base rate. Most of them fail. Many of them, some of them succeed. Those that succeed make so much wealth and create so much employment and do so much good for society that from a societal point of view, what I'm saying is that we need such people. So while it may be from a very rationalistic point of view, it may be the wrong thing for you to do because you're not different from anybody else, uh, and you should, especially when it comes to public market investing, you should. What I mean to say is that you should not ignore all retail companies because retail companies typically end up, they have a very high mortality rate. You don't have to ignore all airline companies. After all, we have seen what Ryanair has done and what Southwest Airline has done. There are value creating companies in the industry which has one of the highest mortality rates as well. So there is something unique about those people, and maybe you can find the next Southwest Airlines, and maybe you can find the next Ryanair, Ryanair, and so on and so forth. So that's the point I'm making here, that you have to, when you're focusing on the research on the individual company that you're working on, don't overweigh it. Don't forget that it belongs to a class of companies or situations where the base rates are not good. But this is exactly where the investing part becomes fun, right? Because if base rates are low, a lot of people don't want to look at those situations, and you're operating in a pari-mutual system. So the whole sector might be disregarded and may end up becoming a good area to look for value because it's been sort of given up for debt. So in that sense, even highly levered companies in the bottom of a recession are given up for debt, and there are a lot of upsides which are not there not been factored in the valuation, and Ben Graham used to think like that. So he would talk about investing in businesses which were very inefficient, which were highly levered, which were the most inefficient producers in an industry, because he expected that the price of the commodity that this industry manufactures is going to go up, and if it goes up, then the profits of the most inefficient player, the most levered player, the highest cost producer will go up the maximum, and the stock price will go up the maximum. And he was thinking about just not the probabilities of success, but of the consequences. So the same thing applies to turnarounds. Warren Buffett wrote, "Turnarounds seldom turn." So he doesn't like investing in turnarounds. That's fair enough. That works for him. But that doesn't mean that you should not invest in turnarounds. You should maybe become extremely selective in identifying certain turnarounds which will not behave like like most turnarounds do. So average out experience is not the same as unique experiences, and that's the point that I want to leave you with.
Yes, sir. So moving on to the next question. So based on what you wrote in your blog post from 2010 onwards, you clearly made a distinction of being a moat investor since then. Prior to that, you were doing a lot of other stuffs like you were into arbitrage, you were into special situations. But I think it is 2010 or maybe 11 from when you clearly focused on being a moat investor. And it's been years now. Would you like to share a bit about your experience as to what worked, what didn't work, and how you have evolved as a moat investor in these 12 years? You may take stock names just as an example, or if you may choose not to take stock names as per your.
I won't take stock in, but I'll talk about see, the basic elementary mathematics of investing in a high quality business is basically irrefutable. If you are paying a reasonable multiple of earnings for a business which will grow its earnings over a long period of time, which earns high returns on capital and is likely to continue to earn those high returns because it has a competitive advantage, entry barriers, and all that. And it is likely that the multiple should expand as the markets sort of start appreciating the inherent quality of the business. You're going to make money, right? I mean, the entry multiple is normal, the exit multiple uh, is is higher. How much higher is hard to say, but it should be higher than what it is. And there is earnings growth that you projected out. So, and I'm not even counting dividends. So your return should be at least the earnings growth. If the earnings growth is 15% a year, and there is a multiple expansion from 11 times earnings to 20 times earnings, even if it happens over 6 or 7 years, the expected return on the stock is very, very good, right? So that's the underlying mathematics of it. Now, so that's the easy thing that to understand. Now, can things go wrong? Of course, things can go wrong. I mean, there's nothing, no certainty here. But the things if they go wrong is not because the math was wrong. It's because the what you thought would happen did not happen. So what you thought was a moated business actually turn out to be non-moated one. So there is, just because you have a high return on capital right now and have had in the last 3, 4, 5 years doesn't mean that you are a moated business. You may be, you may not be. Uh, maybe the jump in earnings was temporary and it was superficial and appearances were deceptive. And over time, profits became more normal than what they were. So fundamental impairment took place. So, for example, a business may be facing elevated earnings because some of the competitors have lost customers because of some mistakes that those customers made, and they lost those customers, and therefore the business has shifted to a business that you are evaluating, and that has elevated earnings, and therefore you start thinking that there is something unique about this business, and the competitors who have lost business have no ability to come back. Maybe that assumption is wrong. Maybe they will fix their problems. Maybe they will win back lost customers. And if that happens, then the number of players in the industry will go back to a higher number than was the case post the shift of market share to the company that you are examining. and therefore the earnings that you thought were normal were actually not normal, they were extraordinary. And of course, in terms of valuation, how to treat extraordinary earnings which will last only a few years versus normal earnings which will last for a long time is obviously very different. The multiples that you'll apply to extraordinary earnings are much lower than you would to earnings that are normal. So that is one thing that can go wrong, that you thought there was a moat, but it was not there. So you made a mistake basically, or the moats got destroyed. Things happen, right? So my favorite example here is investing in a hotel which is in a city which is very prosperous, but it is the only five-star hotel, and nobody else can make more hotels. There are no more permissions, and it is the only asset of the business, and it has pricing power, and the hotel is always full, and so on. But there is an event, there is an earthquake which flattens the hotel. So the value goes to zero because the land was never yours. And imagine that you don't have any insurance. So basically, the value goes to zero in just no time, right? In just a few seconds. So things can happen. Events can happen which can erode the value. See, it's not just competition that erodes a moat. Well, it is normally thought that a competitive advantage is moat and economic castle and all that. There are so many things that can erode a moat. It could be a regulatory change, it could be a change in technology, it could be obviously a competitive attack, it could be management mistakes, it could be so many things, right? So the point is that you may have done your thinking based on, again, studying the history. And one of the things that you tend to do when you study the track record of a business and you like what you see, and you like, and you can clearly attribute the current success of the business to certain attributes, you tend to assume that those will continue. Good guys don't become bad guys normally, right? But that's not always the case. People who run the business may have been thought by you at the time of purchase to be fabulous, but the subsequent track record could indicate otherwise, right? Things can happen. They may have gone genuinely wrong in the way they thought about the future, and they may have made some mistakes or in capital allocation. Some of them were significant and resulted in impairment, or they might end up taking actions which were not in the interest of minority shareholders. They had never done it in the past, but they've done it now. So there are all sorts of things that can happen that can make what you thought was a great business turn out to be not to be the case. Um, and of course, you can go wrong in over optimism in terms of projections. You have some ideas about how the business will perform. It did very well under the circumstances, but not as well as you thought. And there was over optimism in your projections. And obviously, if you're over optimistic, you may end up paying a higher price than you should have paid, and that will result in a return which is lower than what you thought you would get. So there are all kinds of things that can happen. I'm not even talking about macro things that can happen. I think that will come later. You might have some questions on that. Interest rates could go up. There could be economic collapse. Businesses don't exist in a vacuum. I mean, look at what is happening in Sri Lanka. Look at what is happening in the Russian, so-called monopoly businesses. The actions of one guy can destroy the franchise of so many people. Look at McDonald's in Russia; it's gone. So things can happen, um, and it's important to recognize that no matter how well the job that you have done in terms of diligence about the quality of the business, the quality of the management, there are all these underlying assumptions about the continuity of the business, which are based on external factors which are truly not in your control and which could dramatically change, and things can go. And that's exactly what makes life fun, right? It's not like there is no investing strategy out there that is bulletproof completely. There will always be some things that can go wrong in anything that you try to do, and therefore you learn as you go along.
Right. I have a follow up on this, but maybe I'll ask it a little later.
Okay.
So, moving on to the next question. I read this book, Modern Monopolies, last year. I think you would have read this too. Uh, it was a fascinating. It was fascinating to read and also simultaneously observe how things were playing out in the Indian stock market. So, using your moat investing framework, how do you look at platform businesses? What are the characteristics that excite you, and what are your concerns?
See, platform again is a very, people think it's new, but it's nothing new about it. In fact, there is another book which is, I think Samir Arora recommended, and I think it's a wonderful book. It's called A Platform Delusion: Who Wins and Who Loses in the Age of Tech Titans. So I would recommend that book as well. The thing is that platforms have been around for a long time. What is a platform? Platform is a connector, right? It's a connector business model. It connects customers with suppliers. Um, um, so newspapers were platform businesses, right? They connected advertisers with readers, and clearly, if you become a successful platform company, you tend to become very successful. There is this winner takes all kind of attribute. I mean, Google is a platform company, and in terms of search engine revenues, it probably takes more than 90% of the revenues of all search engines out there. So the next 20 search engines will get 10%. And that's not unique to technology platform company. That has also been the feature of platform businesses even before the internet came into existence. The newspaper is a classic example, right? If you even look at Indian newspaper industries before the internet came into existence, Times of India in Mumbai and Statesman in Calcutta and the Hindu in Chennai, they were like dominant, and Hindustan Times in New Delhi. These are dominant papers, and they were extraordinarily profitable businesses, right? And once you have got that advantage, it's hard to be dislodged from that sort of pedestal. So those are features that have been always been present in platforms. But to of course, technology platforms have the unique benefit of high degree of operating leverage, extra revenues result in extra profits. All that is wonderful. But I have concerns. You asked me about concerns, and I've always had these concerns. And one of the concerns that I have is that there is a tendency to believe that once a platform company becomes dominant, it's hard to be displaced. It almost never happens. That's not true. Google is not the first search engine. There was a social media platform called MySpace, which was